Hello everyone, this is Chuck Carnevale, co-founder of FastGraphs, the fundamentals analyzer software tool, and one of the founding members of the Dividend Kings marketplace service on Seeking Alpha. And what I'm currently doing is I'm running a series of articles on mortgage REITs, or what are also known as MREITs. And the first one I did was Dynex Capital Management. This time I'm going to look at Dynex Capital. In the comment thread of a couple of places where this article was posted, I had a lot of criticism about the fact that I didn't really understand mortgage REITs, so I shouldn't be writing about them. And I want to retort that by simply pointing out that before I ever spend the time to do comprehensive research and due diligence on a stock, I first attempt to determine if that stock is actually research worthy or not. In other words, is it worthy of me spending my time, energy, and effort on trying to learn as much as I can about it? And the problem is I've never been able to bring myself to that conclusion when I look at mortgage REITs. Now, they are quite enticing. So let's look at Dynex Capital. Again, we've got a blended PE ratio of 7.68. That's extremely low relative to a lot of companies out there. It's offering a dividend yield of 14.7%, which is obviously extraordinary. The company has no credit rating, and it's a small cap, $368 million market cap company. Now, the company started in like 1989 or 1990, but I can only go back to 2000. But I do want you to notice something about this. I'm using operating earnings here, and the company started their first dividend in 2008. So even though this is a high-yielding mortgage REIT, and I haven't, again, looked at why it didn't, but the company didn't pay a dividend from 2000 into 2008. So I really don't have any color on that. So what I'm going to do here is I'm going to spend most of my time analyzing this company since it actually instituted its first dividend in 2008, because this series is all about high-yielding mortgage REITs, and that's what I really want to cover here. So let's look at it from a couple of perspectives here. Number one is I want you to notice that, and I'm using earnings here, that the company pays out almost 100% or more of its earnings. I'll give you more color on that in a moment. But I also want you to notice by looking at the white dividend line here that the company has cut their dividend no less than 5 times since they've instituted one. So that's a big red flag. I mean, it's very difficult for those retired investors, especially who are living off their income, to endure significant dividend cuts. Now, if you're pre-retirement, you're looking to accumulate, you might be able to reinvest these high yields and do okay over the long run. We'll examine that here later in this video. But the point is that these companies are very inconsistent and unpredictable relative to their dividend income. So let's go ahead and go to the performance results, and let's look at this company since it instituted a dividend and then compare those results to the S&P 500. This is one of the main points I'm trying to get at here. I want you to look at the performance. Now, this is without reinvesting the dividends. This is really focused on those retired investors who would be looking at spending or living off of the dividend income. So if we look at the stock going back, they started their first dividend in 2008 and paid $2.13 a share. Then they increased it by just under 30% to $2.76, increased it again, then again, then again, but then they cut it by 2.6% in 2013. Cut it by another 10.7, almost 11% in 2014, cut it in 2015, cut it significantly in 2016 and 17, and it looks like they're maintaining the dividend so far this year. This is based on a $10,000 investment. If you're looking at the income stream, if you were used to living off of, $1,100 or $1,200 off of this stock in terms of your dividend income, that dropped down to $800 in the last couple of years. And again, that's difficult. Now, I promised in the written portion, because I got a lot of criticism for comparing results. So we're going to start with this, long-term, since they've been paying a dividend, and compare this to the market. Now, they've thrown off just under $12,000 worth of dividend income versus only just under $2,400 for the S&P. But you lost almost half of your principal. So even though you've got all this dividend yield, if you were living off the dividend, you would have actually underperformed the market over this time frame. However, if I switch the time frame by 1 year, you get even more dividend income over this time frame, but once again you had principal loss. You had an annualized loss of 2.5%, and again you underperformed the market. Remember, we're in one of the biggest and longest bull markets in history. We're entering that at this point right here. So then if I drop one more year off, you're down to your $10,000 would have generated $10,000 in dividends compared to $3,000 for the market. But once again, you lost almost half your principal. You dramatically underperformed the stock market. And I'm going to move a little quicker here. I drop it down to the period from 2002 2010 to 2019, you lost more than half of your principal. You did generate about $7,000 of income, but you only made a 2% annualized rate of return versus 12.4% in the S&P. And I think this is the point I'm trying to get across with these videos. When you run these type of calculations and run them quickly like this, you can see how a company like this has performed. Once again, about $7,000 in dividends, lost about half your money, haven't had a total rate of return of 3.4% versus 13% in the average company. Drop another year off, you got $6,000 in dividends, you lost, again, almost half your money. You made about 2% a year versus 13% a year in the average stock as measured by the S&P 500. Drop it down since 2013, you again lost about 40% of your money. You did generate some nice dividend income, but you averaged 3.2% versus 11% in the market. And I'm just going to go through this. You can see the numbers yourself. If I talk about since 2014, you had a negative 10% capital annualized loss every year, but you did just about break even thanks to the dividends, but you averaged 0.8% versus 10% in the market. And again, I just keep going through this, and you see this chronic underperformance of this company against the average stock over these time frames. And these are the most recent time frames I have here. So the point is, in one of the longest bull markets in history, Dynex Capital has not been a really stellar performer. But I also promised something else. I suggested that what I would do in the article, that these companies do tend, or these types of investments do tend to outperform during the recession. So I'm going to go ahead and take this scrolling bar here, and I'm going to move back and look at what this company looked like from a performance perspective during the 2001 recession. And I'm going to be as fair as I can to the company. I'm going to cut off the period, so I'm really looking at just the period 2000 through 2002, that 2-year period. Now here you get extraordinary performance, and I do want to point that out. So during a recession, this company produced unbelievable performance, and it wasn't even a contest compared to the S&P 500. So that is obviously very extraordinary. However, we also get outperformance during the Great Recession. I've picked the time frame here, 2006 through 2009. I do want you to see that. I'm looking at the period, just during the Great Recession here, which lasted that period of time. And you'll see that it dramatically, again, outperformed the market over this time frame. And again, that includes some good years and some bad years in both examples. But here's the rub for this. Given the fact that a lot of people argue for these mortgage REITs that they outperform during a recession, but as I stated in my written portion of my article, it reminds me of the thermos bottle. It keeps hot things hot and cold things cold, but how does it know? And the reality of it is, people are saying buy it just before you come into a recession and then sell it just as the recession ends and you'll do right. But that takes some pretty good timing, and I think that's beyond the scope of the type of timing that most people have. I also want to point something else out about those calculations. I want you to note that during the 2001 recession, this particular mortgage REIT didn't even pay a dividend. So, all I'm doing here is looking at historical performance, and what I'm suggesting by doing that is that I don't think these are suitable investments for mortgage REITs. Now, I'm going to go ahead and switch gears here a little bit and look at reinvesting the dividends. In order to do that, I'm going to go to our additional settings box here, and I'm going to click the reinvested dividend incomes at the end of the quarter. This is how the fast graph research tool that I does, and I'm going to apply settings to this. And what this will do is this will show the performance of this company now by reinvesting the dividends. So once again, I'm going to look at this and reinvest the dividend at the end of each quarter. You'll notice that my share count is growing here, and my dividend income, by the way, also grows over this time frame. These represent quarters, so don't get confused by this. When you have the asterisk, those are just 2 quarters. So the last dividend was $26.56 versus $23.88. But long and short of it is, by reinvesting the dividends, we slightly underperformed the market, but it was pretty close there, going back from the period 12/31/2007 to 2019. So now I'm going to shorten it to 2008 to 2019. And now once again, we see performance that was positive at least. We have a 9% rate of return. We see good dividend growth, and we see a lot of shares being added. But here we're underperforming the market. So I'm going to go through these quickly. We're reinvesting the dividends. We're dramatically underperforming the market from 2009. I go to starting in 2010. Once again, we're dramatically underperforming the market, even though we got a lot of dividend income and bought a lot of shares. I go to 2011 to current, and again, we're underperforming the market dramatically. I go to 2012, we're once again underperforming the market dramatically. I go to 2013 forward, we're once again underperforming the market dramatically. And so I just keep doing this, and I point out that even with reinvesting the dividends in Dynex Capital, I was dramatically underperforming the market. And so, that's, to me, not really that all that exciting. So I want to do something. I'm going to add another wrinkle here. Let me show you what I'll call the premier blue chip dividend growth stock out there. What I'm going to show you here is Johnson & Johnson. Again, I'm reinvesting the dividends, and what I see is outperforming the market since 2007, which is what I share. So from 2008, I'm underperforming the market with Johnson & Johnson, but not too bad, a double-digit return. If I move it down to 2009, I'm still underperforming the market. I move it down to 2010. Now I'm, getting close, but I have produced more dividend income than the market, but slightly underperformed it. I bring it down to 2011, and once again, I'm underperforming the market, but I am producing more dividend income. I do want to make that clear, because to me, that's important. I bring it down from 2012, and I'm getting pretty close to, parity with the market, except I am producing more dividend income by owning Johnson & Johnson. Remember, all the stocks in the S&P don't pay dividends. And, again, I got higher dividend income, and I'm going to just stop here. I think you're getting the point of what I'm doing. But I do want to show you one more example. Instead of showing a, moderate yielding blue chip like Johnson & Johnson, I'm going to show higher yielding Realty Income, another real estate investment trust, probably the premier equity real estate investment trust, by the way, that also pays monthly dividend. Here again, I'm reinvesting the dividends, and I'm looking at the performance starting again with 2007. Significantly outperformed in terms of total dividend income, dramatically outperformed in terms of total return against the S&P 500, and I might add Dynex Capital. Again, I bring it down to 2008, dramatic outperformance by Realty Income. I bring it down to 2009, dramatic outperformance again on terms of dividend income, and very strong outperformance on total return. I get it down to 2010, and once again now I'm getting a little closer to parity with the market, but I'm still outperforming the market, but I'm significantly outperforming what I showed you with Dynex Capital. I get down to 2011, I am again outperforming on total income, I'm outperforming on total return as well, but more moderately. I'm starting to get closer to parity with the market. So, when you're looking at getting total returns and getting a lot of income or building wealth, I do believe you're better off looking at high quality dividend producing stocks, whether they're equity real estates or, higher yielding other, what I would call blue chip dividend aristocrat or dividend champion type companies. Now, in closing, I apparently have struck a chord and even stepped on some toes with this series on mortgage REITs. People love these high-yielding securities, and they want to really fight and argue. And in some cases, some of the comments I got, you'd have thought I'd have called their children ugly or something. I mean, they were really pretty upset that I could be challenging the quality of these stocks. And one stock that came up that was actually thrown at my face, I guess you will, in the comment section was this Dynex Capital. So I thought it'd be fun to show this company and show all the performance history here. I truly do not understand how mortgage REITs make money, but it's because it's by choice. I don't want to, because when I look at their long-term performance results, I just don't consider them suitable, predictable, consistent, high-quality investments that retired investors should go into. They might be pretty decent recession hedges if you can time them right, but I also would consider that to be very, very difficult. But again, each to their own. If you like them and you're happy getting that 14 or 15 or 13% yield, and you're comfortable with the dividend cuts and the lack of predictability, then by all means go ahead and invest, but they're not my cup of tea. Anyway, thanks for listening. If you like what you saw here, don't forget to hit our subscribe button where you can get more videos like this. I'll be covering several additional mortgage REITs over the next several days here as I go along with this video series. Thanks for watching.